Right now, the traditional financial markets are completely blind. The COMEX is closed and the London bullion market is officially offline. But the geopolitical machine does not take the weekend off. And if you know exactly where to look, the early warning systems are flashing bright red. I'm looking at PAXG, and it is sounding a massive alarm for the precious metals market. For those who do not do this homework, PAXG stands for PAX Gold. It is a digital token directly backed by allocated physical gold, and it trades 24 hours a day, 7 days a week. When traditional commodity exchanges shut down for the weekend, PAXG is the only real-time price discovery mechanism we have. It is the weekend smoke alarm for the entire global financial system. And right now, that alarm is absolutely screaming. PAXG is trading at a massive, unprecedented premium over Friday's COMEX closing price. This is not retail traders playing with crypto memes or gambling on altcoins. This is smart money panic buying physical gold proxies because they know exactly what is coming on Monday morning. Historically, whenever PAXG spikes significantly over the weekend, we see a violent gap up in gold and silver when the futures market finally opens. The paper shorts on Wall Street are trapped over the weekend. They cannot manipulate a market that is closed, and they cannot spoof orders when the exchange is dark. But the physical demand does not stop, and it is forcing the PAXG premium into the stratosphere. This is the exact same pattern we saw before the last major geopolitical escalation and the last banking crisis. The institutional players are using PAXG to aggressively front-run the Monday Open. They are securing their wealth before the rest of the world wakes up to the Monday news cycle. And you need to understand the mechanical relationship here. When gold gaps higher, silver does not just follow politely behind it. Silver acts like gold on heavy leverage. It acts like gold on steroids. If gold gaps up 1 or 2%, silver will violently gap up 4 to 6% in a matter of seconds. The global silver market is smaller, much tighter, and infinitely more volatile than the gold market. So when you see PAXG breaking completely away from the paper spot price on a Sunday, you need to prepare your portfolio for a shockwave in silver. The Wall Street algorithms are going to be forced to cover their naked short positions the very second the COMEX opens. They will hit the market with massive panicked buy orders just to stop their financial bleeding. That is exactly how a gap up is born. The price literally jumps completely over the stop loss limits, wiping out the retail shorts instantly. If you are waiting for Monday morning to analyze the market and make your moves, you are already way too late. The pricing structure is being rewritten right now in real time on the blockchain. The smart money is pricing in a massive risk-off event, and they are using PAXG as their weekend lifeboat. But PAXG and the weekend premium is only half of the story. Because while the weekend trading is signaling a massive demand shock, there's a physical supply shock brewing down south that is exponentially more dangerous. Mexico is sounding a physical supply alarm that Wall Street is absolutely terrified to talk about. Let's talk about Mexico, because this is the fundamental nightmare that Wall Street is desperately trying to ignore. Mexico is the undisputed heavyweight champion of global silver production. They pull more silver out of the ground every single year than any other nation on the planet. If the Mexican silver supply chain even sneezes, the global industrial sector catches a lethal case of pneumonia. And right now, that supply chain is not just sneezing, it is going into absolute cardiac arrest. We are tracking a violent convergence of catastrophic events hitting the Mexican mining sector all at exactly the same time. First, you have to look at the massive labor strikes completely paralyzing some of the most critical silver mines in the country. When major Mexican operations shut down for even a single week, millions of ounces of physical silver are instantly erased from the global supply forecast. You cannot simply flip a switch and turn a subterranean mining operation back on when a labor dispute finally ends. It takes weeks, sometimes months, to safely restart these massive, complex industrial operations. But the labor strikes are just the surface-level problem that the mainstream financial media will actually report on. The much darker reality is the explosive rise in cartel extortion and violence directly targeting the mining infrastructure. Heavily armed syndicates are hijacking physical silver shipments right off the desert highways. Just recently, we saw the horrifying abduction of mine workers at operations like Vizsla Silver, forcing companies to completely halt activities because of severe security threats. The cartels are aggressively extorting the mining companies, demanding massive cuts of the revenue just to allow the transport trucks to pass safely. This is forcing major mining corporations to spend millions of dollars on private mercenary armies just to move their metal to the refineries. Every single ounce of silver that is stolen or delayed is an ounce that never makes it to the COMEX vaults in New York. And if that was not enough to choke the global supply, the political environment is turning violently hostile against the foreign miners. The Mexican government is aggressively tightening environmental regulations, pushing restrictive new water laws, and halting the issuance of new open-pit mining permits. They have already slashed the maximum length of mining concessions from 50 years down to 30 years. They are openly signaling a massive wave of resource nationalism, hinting that they want to keep their strategic metals inside their own borders. When the largest silver producer in the world stops issuing permits and shortens leases, the future supply pipeline completely and instantly collapses. You have to remember that physical silver is a rapidly depleting asset. The easy, high-grade ore was pulled out of the ground decades ago by the previous generations. Miners in Mexico are now forced to dig deeper, spend more capital, and burn more energy just to extract a fraction of the silver they used to find. The energy costs are absolutely skyrocketing, the security costs are exploding, and the geopolitical risks are completely off the charts. This dynamic creates an absolute unbreakable floor under the price of physical silver. The mining companies simply cannot afford to pull the metal out of the ground at these artificially suppressed, manipulated paper prices. They are essentially subsidizing the entire global green energy transition at their own financial expense. But that charity is coming to a violent, abrupt end right now. When Mexico physically shuts the supply valve, the global silver deficit goes from a manageable spreadsheet problem to an absolute existential crisis. So we have the ultimate fundamental collision forming right in front of us. On one side, you have the PAXG weekend trading data screaming that the institutional smart money is panic buying physical gold and silver proxies. That is the demand shock. On the other side, you have the largest silver producer on earth, Mexico, functionally shutting down its supply chain due to strikes, cartels, and government restrictions. That is the supply shock. When you slam an unprecedented demand shock into an irreversible supply shock, and you trap it behind a closed weekend futures market, you create a financial pressure cooker. And that pressure cooker explodes the exact second the COMEX opens for trading on Sunday evening. This is where you need to understand the brutal mechanics of a gap up. For decades, the bullion banks and the paper short sellers have controlled the price of silver by flooding the market with digital contracts. They sell silver that does not exist to suppress the price and trigger your stop losses. But their entire manipulation algorithm relies on one critical assumption: liquidity. They need a continuous, flowing market to slowly walk the price down. When the market is closed over the weekend, they are completely blind, completely paralyzed, and completely trapped. Now, while they are locked out of their trading terminals, the physical reality is repricing the asset in the real world. The industrial buyers looking at the Mexican supply collapse are calling their brokers and demanding physical metal. The institutions watching the PAXG premium are queuing up massive market order buys for the very first second of the Sunday open. So, what happens when the opening bell finally rings? The price does not just tick up a few cents, it violently teleports, it gaps higher. A gap up means that the lowest price on Monday morning is significantly higher than the highest price on Friday afternoon. There's a literal blank space on the chart where absolutely no trading occurred. And that blank space is a graveyard for short sellers. If a hedge fund is shorting silver at $35 and the market gaps up to $40 at the open, their stop loss orders are completely bypassed. They do not get to exit their position at $35.10. They are instantly underwater by $5 an ounce, multiplied by thousands of leveraged contracts. This triggers an immediate catastrophic margin call from their prime brokers. The brokers do not ask politely, they forcefully liquidate the short seller's account. And how do you liquidate a short position? You have to buy the asset back at the current market price. So, the very people who were betting against silver are now forced to become the most aggressive buyers in the market, just to stop their own bankruptcy. They have to buy at $40, which pushes the price to $42. Then the next short seller gets margin called and has to buy at $42, pushing it to $45. This is the short squeeze feedback loop. It is a cascading failure of the paper market structure. And it is all triggered by that initial violent gap up at the market open. The algorithms that usually suppress the price suddenly flip, they see the momentum, they see the moving averages crossing, and they start buying the breakout. Within minutes, a market that was calmly trading sideways on Friday is in an absolute vertical free fall to the upside by Sunday night. If you are sitting on the sidelines in fiat currency, waiting to buy the dip on Monday morning, you're going to be left standing on the platform while the train leaves the station. You cannot buy the dip if the dip no longer exists. When silver gaps up, the new floor is established instantly, and the old prices become a permanent part of history. This is why holding the physical asset before the weekend is the only true defense against the paper manipulation. So, here's the final verdict on the weekend warning signs. We are looking at a textbook setup for a historic market dislocation. On one side of the ledger, you have the PXG token sounding the alarm in real time. The smart money is using digital gold proxies to escape the fiat banking system while the traditional markets are frozen. On the exact opposite side of the ledger, you have the physical reality in Mexico. The largest silver-producing nation on the planet is violently choking off the supply line. Cartel extortion, labor strikes, and resource nationalism are permanently destroying the mining pipeline. This is not a temporary supply chain glitch that gets fixed in a boardroom. This is the structural breakdown of the global silver industry. And all of this incredible pressure is building up while the Wall Street paper market is completely offline. The bullion banks are sleeping, but the geopolitical machine is wide awake. When the COMEX finally opens, that pressure has to go somewhere. It cannot be contained by digital algorithms, naked shorts, and spoofed sell orders. The physical market is going to violently reassert its dominance over the paper illusion. And that is exactly why silver is perfectly positioned to gap higher. If you are watching this right now, you are officially ahead of the mainstream herd. You have the data that the financial media will not report until it is far too late. They are going to wake up on Monday morning, look at the explosive green candles on the chart, and wonder what just happened. They will scramble to find an excuse, blaming it on a random inflation print or a minor geopolitical headline. But you will already know the truth. You will know that the Mexican supply shock and the institutional panic buying collided over the weekend. So, what is your battle plan right now? Your first directive is to stop waiting for permission from the television to protect your wealth. If you do not hold the physical metal in your own hands before the gap up, you're completely at the mercy of the banking system. You cannot buy physical silver at Friday's paper price on a Monday morning if the market has already teleported higher. The premium on physical coins and bars will absolutely skyrocket the second the futures market opens in the green. The dealers will instantly widen their spreads, and the available inventory will simply vanish from the shelves. You have to position yourself before the event, not after the reaction. This is exactly how the apex predators operate in a rigged financial system. They read the tape, they track the physical supply chain, and they act while the rest of the world is paralyzed by the weekend. I want to know exactly who is paying attention to these weekend warning signals. I want to know who is front-running the Monday Open and securing their physical assets while the banks are blind. Drop a comment below right now with the words, "I see the gap." Let me know that you are tracking the Mexican supply shock and watching the institutional money move. The paper market is about to face physical reality. Let the weak hands wait for Monday. The wolves are already positioned. Stay liquid. Stay dangerous.